In this video, I'll be going through Work Together Problem 10-1 from our Century 21 Accounting Textbook, Advanced, in Edition 11. This problem is found on page 302, and it reads on issuing common stock. Page 6 of a cash receipts journal, that's here, is provided. The source document is abbreviated as follows. Receipts are R's, and your instructor will guide you through the following examples. That's me. So the first transaction, June 5th, Harold Davis purchased 6,000 shares of Glasstown Incorporated common stock for $8 per share. Receipt number 242. Journalize the transaction using each of the following assumptions regarding the common stock. In assumption A, we have $1 par value. So the journal entry will be June the 5th, and the account title we're looking for is Capital Stock Common. Okay, document number looks like receipt 242. And then our general credit will be for 6,000 shares at $1 par value is going to be $6,000, right? 6,000 times $1 is 6,000. And our cash debit will also be $6,000. However, we didn't receive just $6,000. It has $8 per share value. Okay? So then we have to do the math down here on paid in capital in excess of par value common. Okay. So what we might want to do is just make this a little bigger so we can read it all. Alright, so we have 6,000 shares times $8 per share, but that's $1 per share over the common, so it'd be 6,000 times $7 per share would be the excess amount over par value, right? So 6,000 shares times $7 is $42,000, which means that our cash debit, the difference between them, this wouldn't go down. It means that it would be those two amounts added together, right? So it'd be 6,000 plus 42,000 is 48,000. And now our debit equals the sum of our two credits, so that one works. Okay, that was with a par value of $1. Now assumption B, same thing, June the 5th, and it's just going to be the capital stock common. So this time there's no par value. We know that it's worth $8 per share. So it's just going to be receipt number, same one, 242. And then our credit will be just 48,000 and cash debit 48,000. Okay, that one's done. Now assumption C, $1 stated value common stock. So we're same day, this is just a different way, different assumption. And this time it's going to be capital stock common. Remember, stated values are treated very much the same as par value. So it's going to be very similar to our first entry, right? Capital stock common, and then paid in excess, or paid in capital in excess of stated value common. Okay, same receipt number. We're just going to do it a different way this time. And then it's going to be the same as before. If your stated value is $1, there will be 6,000 on that capital stock common, and then there'll be 42,000 on your in excess, because that will get us to the $8 per share, right? So again, 48,000. This is three different assumptions for essentially the same thing. It's just distinguishing between whether or not it's a $1 par value, no par value, or a $1 stated value, right? So those were our three different options, and that's all there is to it. pretty simple stuff. And you can do the on your own.